Bill Dudley, you separate the men from the boys, the women from the girls, with the logic theory of necessary and sufficiency in an undergraduate class. You speak of the necessary and the sufficiency that we saw yesterday from Chairman Powell. What did he do that you say was not sufficient?
Well, I think that he did a good job in basically edging closer to the notion of we're going to do the taper, but not so much so that it puts the markets on edge. The general expectation at this point is Fed probably won't start tapering, probably won't make the announcement on tapering until November or December, and probably won't start until early next year. So I think he did a good job on that. Where I would say the Fed hasn't gone far enough is the changes that they've made in terms of their standing repo facility that they announced yesterday. It's a good start to have a standing repo facility to backstop the Treasury market, but they capped its size at $500 billion, and they limited access to only primary dealers. And I think the access should be considerably broader than that to support the functioning of the Treasury market. Also, I think they need to make changes to their capital requirements so that when the Fed buys Treasuries and agency mortgage-backed securities, and that increases reserves in the banking system, that doesn't interfere with good market functioning in the Treasury market.
These are delicate phrases, and we appreciate the candidacy as a former government official. Bill Dudley, we have the overnight repo market now moving back up through $1 trillion. Let's cut to the chase here. If the overnight goes near $1 trillion, above $1 trillion, how will the Fed adapt and adjust to that?
There's no magic number that where if the Fed is soaking up $1 trillion of repo through their reverse overnight repo facility, that's not a problem. But I think it does tell you that there are consequences of the Fed's asset purchases. The banking system is essentially awash in reserves, and that's making the leverage ratio more binding, which is constraining banks' activities, and it's also causing banks to essentially push away corporate deposits. The Fed could fix this by making changes to how the leverage ratio is calculated, and I think they should do this sooner rather than later.
Is the Treasury market as it is now broken?
No, I don't think it's broken. It just needs a little bit more belt and suspenders. The standing repo facility is a good start, but as a Group of 30 report was published yesterday points out, there's a lot of other things that need to be done to the U.S. Treasury market. The G30 report talks about central clearing of treasuries for customer trades. That would make the market, I think, a lot more solid. It talks about increasing the transparency in the U.S. Treasury market. So having a standing repo facility is a good start. But there's a lot more to put the U.S. Treasury market on a firmer footing.
This may sound esoteric. It is not. It is the underpinning of what we pay for all of the loans that we take out is the underpinning, frankly, the functioning of Wall Street. And there is a question about the functioning of the Treasury yield as an indicator right now. Even Fed Chair Powell came out and said he didn't quite understand why yields were where they were. And a lot of analysts have raised the issue of liquidity, the fact that there are these malfunctioning aspects of the bond market that made it very difficult to get a clear signal from treasuries. Do you think that that is a factor in yields that are persistently low given the inflationary outlook?
Well, I'm surprised by how low long-dated treasury yields are given the level of inflation, the fact the economy is in recovery mode, and the fact the Fed has said that they're going to be very, very patient before they actually raise short-term interest rates. In that environment, you would think treasury yields would be higher. I think what's really happening is quantitative easing is very, very powerful. As the Federal Reserve buys more and more assets, that creates deposits in the banking system that people don't want to hold. And as they don't want to hold those deposits, they bid up other financial assets. So I think we're just finding out that quantitative easing is very, very powerful in pushing around bond yields and bond prices.
We toss around the phrase reaction function, Bill Dudley, in the media like it's a mint. There's a mathiness to it. Can we generate constructive reaction functions given the wall of liquidity, or do we just need to become inured to the idea we will have jump conditions, we will have suddenness over the next many 2, 3, 5 years?
Well, we'll have some suddenness in the sense that the Fed at some point is going to go from maximum monetary policy stimulus to something else. And at some point, the Fed is actually going to lift off and raise short-term rates. The Fed, I think, is going to try to minimize that jump function by communicating clearly. And I think they've done a pretty good job in terms of, signaling when the taper might take place and that it's going to take place in a gradual and in an organized type of way.
Before we came on, we were alluding to Alan Greenspan and Bill Dudley and to Arthur Burns. And do you just assume, and I say this, Dr. Dudley, very carefully, that we have, as we become less accommodative, a measured Greenspanian approach? Are we going to go back to a Fed that's more ad hoc, like we saw with some of the sudden lifts and larger lifts in the Burns era?
Well, I hope we don't go back to the Burns era, because at that time, the Fed was very, very late in terms of raising interest rates and pushing down inflation. So that would be a very bad model. I think that what the Fed is doing, though, is basically saying we don't really know exactly where full employment is. And so we want the economy to run a little hot so we can find out where full employment is and make sure we employ the maximum number of people we can without having a long-term inflation problem.